Welcome to this month's webinar. This will be part 2 of the webinar that we held last month. Hopefully you had a chance to join us for that webinar, or you have had a chance to see it online. What we did last time was we talked through the first 6 out of 12 bullet points, these are issues that, aside from the valuation, can have a material effect on the value of the deal. The 6 that we talked about last time were more akin to, or something that you might find in the letter of intent or shortly after the letter of intent. The 6 that we're going to talk about today are the 6 that are a little closer to or actually involved in the purchase agreement itself. So we're kind of moving through it chronologically. I have the list on the screen there, so you can see the 6 that we went through last time in white and the 7 in yellow that we'll go through today. So as always, I have Sam here with me, who will be taking questions throughout the webinar, and then we'll have some time at the end for Q&A. And if you'd like to ask a question, on the right-hand side of your screen, you'll see a little vertical bar with an orange box with a white arrow. If you click on that, a little menu pops out of the side, and there are 2 things of interest there. One is the place that you can put in your questions through the chat feature, and secondly, we have a few PDFs that we've put together for this presentation. And some more things about M&A more generally, and you can download those in Acrobat from Adobe Acrobat from Adobe PDF from the side of the screen. So, all right, I don't want to go over the first 6. We'll just jump right into the 7th. And this is going to be the thing that we're going to talk about, spend the most time talking about. It's the most complex. And that's net working capital. So the valuation process largely centers on the income statement of the business, where the buyers are valuing the business based on revenue, EBITDA, cash flow, profitability, growth, consistency, and margins. But the working capital is the part of the process where your company's balance sheet will come into the transaction. And so it's not, the balance sheet rarely, if you're a successful operating business with some growth and some profit, the balance sheet is typically fairly irrelevant to the transaction value. But when it comes to net working capital, it becomes very important. And we discussed a little bit last time about liquidity, but I'll refresh on that. The buyers want to make sure that after we've squeezed every penny that we can out of them to pay the purchase price for the business, they don't have to turn around in a week or a month or 2 months and pump more cash into the business. They want to make sure there's no liquidity crisis. They want to make sure that the short-term assets exceed the short-term liabilities. In other words, the assets available to run the business and be consumed in the next 12 months exceed the liabilities that they would expect to have to pay in the next 12 months. And so net working capital is originally there as a measure of liquidity. And there are 3 purposes to the net working capital adjustment to the purchase price. The first is, as I said, the buyer wants to make sure that the business is not illiquid, that they won't have to pump in cash. They're actually buying an ongoing concern with all of the assets necessary to run that business, including the short-term assets. So that's the first reason. The second reason is, as we discussed last time, these deals are typically done on a cash-free basis, meaning all of the cash in the business, with perhaps an exception to keep some money in the till so that the cashier can make change for the customers, but essentially all of the cash belongs to the seller, and it stays with the seller. It goes to the seller when the business is sold. So sellers quickly realize, after signing the letter of intent, that they're strongly incentivized to convert assets into cash and to retain cash as opposed to paying off liabilities. So there is a, I want to say an inclination, because it's something that shouldn't happen and it doesn't really happen, but if it was allowed to, there's an incentive for sellers to sell off the inventory and not replenish it, because you have to spend cash to replenish it, and selling it generates cash. There would be a tendency to accelerate the accounts receivable and collect as many as you could before the closing, because when you collect it, it becomes cash. And there would be a tendency to stretch all of your payables so that you don't have cash going out the door, and those payables become the buyer's problem after the closing. So that's the second reason that the net working capital adjustment has, for decades, been a part of M&A transactions is to ensure that the seller continues to run the business in the ordinary course with regards to how it handles cash and other types of short-term assets. So those are 2 out of the 3 reasons, and those are what I call the 2 legitimate reasons. The third reason is an illegitimate reason, and that's because buyers, and this wasn't true, say, 10 years ago, maybe even 5 years ago, we wouldn't have said this, but we have seen a large number of buyers come in and try to use the net working capital adjustment as an effective purchase price reduction without having to use the 3 dirty words, purchase price reduction, but it has that exact effect because the net working capital adjustment will say, if the net working capital is too low on the closing date, I will take back $1 of purchase price for every $1 that it is low. And so if the net working capital adjustment isn't negotiated correctly and set up correctly, and the seller doesn't apply some thought and strategy to it, the buyer has an automatic windfall. And while the valuation might have been a certain number, it's going to be a certain number minus something if this isn't done carefully. So there are 5 or 6 different kind of fights that the buyer and the seller have when they're working around this net working capital issue, and that's why we have to spend a fair amount of time talking about it. And the first one is how to define net working capital. Net working capital is not defined by GAAP, so accountants use it frequently, but there's no standard definition. This means that in every case, the buyer and the seller need to agree on a definition and put it into the purchase agreement. So I have on the screen here 2 different definitions. There are a multitude of definitions between these 2. The definition on the top is the broadest definition, and the definition on the bottom is the most narrow definition. So keeping that in mind, we'll discuss the one on the top a bit there. In the common parlance, even though it's not officially defined anywhere, working capital or net working capital, that's the definition that it usually, outside of mergers and acquisitions, would have. Current assets minus current liabilities. Another way to say that is all assets that are anticipated to be used in the next 12 months for the business, minus all liabilities the business is anticipated to have to pay in the next 12 months. So that's the broad and kind of common definition. And that doesn't work a lot of times in M&A. So what we see a lot of times, probably the most common definition is the one on the bottom, which really boils it down. So what that says is AR plus inventory minus AP. So it's one type of current asset plus a second type of current asset minus a type of current liabilities. And that's a fairly good definition for most transactions, because as I just went through that second concern, or the second reason for the net working capital adjustment, hey, I'm going to accelerate my receivables, sell down my inventory, stretch my accounts payable. Those are the 3 things that are most manipulatable by a seller between the letter of intent and the closing. So a lot of times, if a buyer can get protection in those 3 areas, they're okay, and they think that serves the purpose for a net working capital, and they'll go with that. Other buyers want a little more protection, so they want something a little closer to the top definition. The reason the top definition is typically not a good definition, a couple of reasons. One, many companies in the middle markets and lower middle markets don't do all the accruals that you would normally do in accordance with GAAP. So for example, a lot of our clients don't set up reserves for uncollectible debts or accounts payable that have gone stale. They don't write off accounts payable that's gone stale. They don't write off inventory that's gone stale. They don't write down inventory when it needs to be written down. They don't set up various different types of reserves. Many clients don't have an accrual for their 401k match. They just put it on at the end of the year. They also might not accrue their paid time off or sick days. So there's a lot of things that, if you're saying all current assets and all current liabilities as defined by GAAP, well, our clients don't really know what those are, and they don't know what they should be at closing. Nor would the buyer, because with a lack of record keeping on those line entries, it's hard to say what they should be on a closing date. So that's one reason why that upper definition, which might seem very simple, doesn't work very well. The second reason it doesn't work very well is accounting serves a certain purpose. So the definition of current assets and current liabilities is good for the general purposes of accounting, but some liabilities, for example, aren't truly things that will ever amount to cash. So for example, accrued time off or paid time off. right? It should be accrued throughout the year. But if the company has a use it or lose it policy, their accrual for that paid time off is probably going to go up a lot throughout the year. So if they're doing a deal, say this time of year or in October, November, they're going to have a large liability on their books that the buyer is never going to have to pay that off. Yes, some employees will leave before the end of the year and they'll get paid out for that time, but most employees will use it all up as the holidays come, and therefore no one has to pay for it. Or if the company has a use it or lose it policy, the end of the year will come and it gets erased from the books at no cost to the company or the buyer. So there are a few things like that. Prepaid expenses, prepaid revenue or unearned revenue is another issue. So there are some line items that are particularly tricky. Every business, every industry is a little bit different. So every deal really requires its own definition of net working capital, unless the buyer is willing to agree to the one on the bottom, and that makes sense for the seller. So all of these different 5 or 6 different fights with net working capital that I'm going to talk about today are things where you need to apply some strategy to make sure that you don't walk into a minefield or set yourself up for failure. Second fight, GAAP. So buyers in their purchase agreements will want the seller to say that everything is here, there, and everywhere is done in accordance with GAAP. And the vast majority of our clients are not comfortable giving that representation because they've not had a legal requirement to use GAAP. If they're owner-operators, they'd probably not put too much importance on the financial statements other than, for taxes, obviously. And tax accounting is not GAAP accounting. So the buyers are basically asking the sellers to make promises about their historical financial statements that they can't make because they don't know, and they're not going to pay someone to go back and look at the last 3 years or whatever of their books and conform them to GAAP. In addition, some businesses, some industries deliberately don't run in accordance with GAAP. So, for example, a property rental company might use cash accounting, but for the collection of the rent checks, they would use an accrual basis, because otherwise, if the first of the month was on a Sunday, then they'd have no revenue that month, or hardly any revenue, and the next month they'd have double the revenue. So why are you even keeping financial statements if it's giving you wacky results like that? So some clients, some companies deliberately make changes to their financial statements not to keep them in accordance with GAAP. So if you're trying to come up with a definition and you're going to have monetary amounts tied to the definition, and you won't say that the definition is as defined by GAAP, buyers get a little bit antsy about that. It results in a little bit of extra diligence being done, a little bit of extra negotiation, and what we try to have our clients and their lawyers do is, if the buyer's requiring it, come up with an exhibit to the purchase agreement that says, here are the relevant ways that the company does not comply with GAAP on its historical financial statements. And then when it comes to defining that net working capital definition, we make reference not to GAAP, but to that sheet, or maybe to GAAP as modified by the sheet. But I've seen times in the past when I've represented buyers, over a decade ago, where the seller would agree to net working capital or other things by GAAP, and then afterwards the buyer would find out the seller was nowhere near GAAP. And obviously, if that error helped the seller, the buyer's probably not going to go back and tell the seller. But if it resulted in the buyer somehow getting some more money or retaining some of the purchase price or the escrow, then they're going to point it out to the seller. So how you deal with GAAP and the net working capital definition is very important. The third thing that the buyer and the seller will kind of dance around is the process for the net working capital. So as I said earlier, the net working capital adjustment goes in the purchase agreement, and it says the purchase price is X. But if the net working capital is too low, it's X minus the amount by which it was too low. Okay, so how do you establish what the net working capital needs to be at closing? And there's 2 processes. So the first process is on the left-hand side, and that's the one I think is more favorable to the sellers. And the one on the right, unfortunately, is the one that is probably more favorable to buyers. Like a lot of the things that we're talking about in these webinars, the interests of the buyer and the seller are diametrically opposed. So on the process on the left, the target net working capital, well, actually, this is true for both processes. The target net working capital is set ahead of time. And there's a whole fight about how that's set, but we'll deal with that separately. So they agree ahead of time, and they put into the purchase agreement, target net working capital is $200,000. Then with the first process there on the left, the seller has an obligation on the closing date to deliver a closing balance sheet that says, and a calculation of the net working capital as of the closing. And that's typically called the estimated net working capital. So if the estimated net working capital is below the target, the purchase price on the closing date gets reduced. That's the first adjustment. And then again, with the process on the left, typically 90 days after the closing, the buyer calculates what's typically called the final net working capital, and they provide that to the seller, and they say, hey, that estimate you gave us at closing was wrong. Or they say it's right? But if they say it's wrong, they say, hey, so therefore we need to make an adjustment to the purchase price. You either give me some money back, or we take some money out of the escrow, or perhaps we add something to the purchase price. But it's a three-step process. Now, the process on the right-hand side eliminates that estimated net working capital. So at closing, and now this is good for both sides, because when the closing arrives, everyone is worn out, angry, upset, a little bit nervous, and anything you can avoid doing, you like to not have to do, because you need to focus on something else that seems important. So that second process, you don't do the estimated net working capital at closing. You set up the target just like in the other process, and then typically 90 days after closing, the purchase agreement will say, maybe it's 60, maybe it's 120, it's usually 90 days after closing, the buyer's accountants will come back and say, okay, here was the target and here was the final. So here's the difference, or here's the final, and here's the difference. And we make a purchase price adjustment. So the reason I say the second process is worse than the first process for the seller is because, as I said, the seller's very busy at closing. And the last thing they're going to probably remember to do is say, ooh, 90 days from now, the buyer's going to come back with a final net working capital calculation, and I'm going to have a chance to review it and contest it. So I better collect all the data I need right now, because what's relevant is the working capital as of the closing date. So if the seller's not forced to do it because of the estimated net working capital requirement, they will oftentimes not collect that data. Sell the business, 90 days later, 120 days later, the final net working capital statement comes from the buyer, and the seller says, oh, I don't know, we closed on March 12th, and I don't have a closing balance sheet for March 12th. I didn't make all the adjustments as of March 12th, so how can I really contest this? I don't have the best data available. That's why I say, even though it's more cumbersome, the three-step process with two different adjustments is typically better for the seller. That is the most common form that we see in purchase agreements. And when we see the two-step, just the one step, the target plus the final, we have a conversation with the client and the client's attorney and try to explain what I've just gone through here to see about putting in that estimated net working capital at closing. All right, the fourth issue, setting the target. This is often the biggest fight. There are two ways the target net working capital can be set. The first and most common is to look back over some historical period and come up with an average. The second and less common is to look for, well, you're still looking backwards, but it kind of sounds like you're looking forward. The buyer will say, I want 3 months of net working capital or 2 months of net working capital. And what that means is they want enough short-term assets to cover the expenses of the business for a certain number of months. Much more complicated calculation. We try to stay away from that. It's very subjective. It's much harder to get agreement on that. It's not necessarily easy, but it is easier to get agreement using the first method, which is to come up with an average and use that as the target. So the strategy or the gamesmanship that comes up here is, what's your measurement period? What data points are you using to calculate the average, right? So first you have to define net working capital, then you have to look, and if the 3-month average is $100,000 and the 6-month average is $200,000, I can guarantee you the buyer will ask for the 6-month average because it's higher. And if the 12-month average is $300,000, I can guarantee you they will suggest using the 12-month average. So the buyer will have gone in ahead of time. The minute the definition is agreed, or even part of coming up with the definition, they have their teams of finance people combing through and trying to come up with the highest rational number that they can propose. And I will tell you, every time we see these numbers come from buyers, it is always the highest rational number. Sometimes it's an irrational number. They'll use a 13-month average or a 9-month or a 10-month average or something that doesn't make sense. just because it's the highest possible number. So the seller needs to be doing the same thing, but trying to find the lowest possible number. And then what happens is the buyer has their basis for rational basis for a high number, the seller has their basis for a low number, and there's a negotiation that takes place, and the number is set in between those two. Setting that target is tough. A couple other factors that come in there that need to be thought about, and that can cost you a lot of money if you blow them. You're going to be using, hopefully, at best, monthly closing numbers. Well, those reflect the liquidity of the business as of the close of the month. And so, if you're involved in your company's bookkeeping at all, you know that a lot of stuff happens right before the end of the month, and that affects your balance sheet on the 31st. Your balance sheet on the 31st probably looks very different than your balance sheet on the 27th or your balance sheet on the 5th. So even a couple days away from that date, things change a lot. Not all transactions in M&A close on the month end. Sometimes they close on the 13th or the 12th, or they close on the end of a payroll cycle that might be the 28th or the 2nd, or maybe the end of the month is a weekend that month, so they close on the 28th or the 2nd of the next month. It's kind of common to try to get a month-end closing, but there's a lot of other considerations, some of which we'll talk about today, that mean you shouldn't always just wait for the next month end. So how accurate is your month-end financials in terms of your current assets and current liabilities compared to the 13th or the 18th or the 7th of the month? It may not be highly relevant, which circles back to another reason why a good definition is the smallest one possible, right? Current accounts receivable plus inventory minus accounts payable is a great definition, because those things tend to not bounce around so much at month end as opposed to other things like, accruals for rent and things like that. So that's another issue with setting the target. The last thing I'll talk about setting the target is seasonality. So imagine your company makes toys. You're pretty much, no matter what definition of net working capital you use, if you're a toy manufacturer, your net working capital in September and October is probably much lower than your net working capital on January 2nd, right? So on January 2nd, you're probably loaded with cash and accounts receivable. Back in September, October, you're probably loaded with accounts payable and other liabilities that you've been using to buy your raw materials. So when you don't know what the closing date's going to be, it can be hard to set that net working capital target early and figure out how to avoid stepping into, again, a minefield. If you set it and then the deal happens to close when for some reason your working capital is not where it normally would be, or not where it would be by using an average. So very complex process of setting that target. This is where it really helps to have a broker or financial advisor with you who can who's done this and can set up the tables and go through it and explain the risks and the different strategies to you and help you communicate those to the buyer. Number 5, fifth issue with net working capital. Sorry, I said net working capital was going to be long. The other ones will be much shorter than this, but almost done with net working capital. Is the adjustment symmetric or asymmetric? The buyers sometimes will put forth a purchase agreement that says, if your estimated net working capital or your final net working capital is below the target, there will be a dollar for dollar reduction in the purchase price. And so the seller says, well, what about if it's above the target? Do I get a dollar for dollar augmentation of the purchase price? And sometimes the buyers will say, well, remember why the net working capital adjustment's here? It's here to protect us. We're the buyer. So we just want to make sure that you don't mess around with your company's assets, trying to pile up cash and leaving us with liquidity problems. It's only there to protect us. It's not, the company's not inherently more valuable because you happen to have a little extra inventory on a closing date. I'm not buying your business based on the value of the tangible assets, short-term or long-term. I'm buying it based on the future cash flows. And the purpose of the net working capital is just to make sure you have enough net working capital, not the right amount of net working capital. So they'll oftentimes try to make it asymmetric. It can only go down. We get in there with our clients and we push, and almost always it comes out being symmetrical. So if the net working capital for some reason is a little bit higher than the average, the buyer gets the seller gets a nice windfall and a little higher purchase price. Again, if you don't know to ask for this, though, you're leaving money on the table that you could get regardless of whether your multiple was 6 times or 8 times or 4 times or 10 times. You're leaving that money on the table. You got to know to ask for these things, and you got to know how to push for them. Finally, on net working capital, why has this become such a big deal? Kind of got into that earlier. I want to talk about a little more detail though. The M&A markets were less liquid 10, 15 years ago. So when a buyer came in and said, I know I said I would pay $20 million for your business, but now that I've done my diligence and something changed on Mars or wherever, now I can only pay $18 million. Sorry, purchase price reduction. And in an illiquid market, the seller might not have a lot of options. However, in the last 10 years, liquidity is still not great for businesses. You're still selling predominantly something with intangible value. However, particularly if you've gone to market, you've run a process, you've got a broker, you're either going to, as a seller, when they say purchase price reduction, you're either going to be able to say, I'm going to go back to market and find someone else, or even better, you're going to say, hey, there was somebody who wasn't that far behind you in the bidding. With this reduction, you're now in the number 2 spot. So goodbye, and I'll go back to who was previously my number 2, and now they're my number 1, and I'll do a deal with them. So as long as you can have those credible threats, it made purchase price reductions, as I'll call them naked purchase price reductions, very difficult for buyers to pull off. And so nowadays we see buyers really trying to avoid using that terminology or anything that would be called a purchase price reduction. And one of the things that they've moved into as a proxy is this net working capital. And we've seen them over, say, the last 5 years really try to get those net working capital estimates really sky high. So they have a built-in purchase price reduction, which, if they turn out that they don't need it at closing, then they can appear gracious and say, well, we'll just don't worry about the net working capital, we'll waive that. But if they really need a purchase price reduction, they can throw it in there and knock 5% off the deal value sometimes, if it's done really poorly. So that's why this has become such a big deal. The net working capital has probably become the number 1 financial issue after the strict valuation of the business, the headline number for the valuation. And that's why it was worth so much time. All right, moving on to the 8th point on the list, the second point for today, indemnification. So because you're selling primarily intangibles, the buyer needs comfort that if you've told them something that's untrue, they have a remedy against you. So they will make the seller give representations and warranties, as well as some covenants in the purchase agreement. And then there will be a clause right after those that says, if you breach the representations and warranties or fail to perform the covenants, you have to indemnify me. And there will be some specific rules around that process of how you indemnify them. Usually they'll take money out of the escrow or take money off of the seller note first, and then after that they'll want to come back to you for additional money if their damages are high enough. So you want to try to constrain that obligation. You will not be able to sell a business without giving reps and warranties, covenants, and indemnification. So the name of the game is to reduce or shrink that tumor to the maximum degree possible. So I'm going to talk about 3 or 4 ways that this can be done to benefit sellers. So the first one is caps. So it used to be, when I started doing this about 20 years ago, the caps we saw were typically the purchase price. So the seller would be liable. They'd have to potentially give back all the money they received if they violated a representation and the buyer was damaged as a result. Fortunately, we've seen over time that shrink down. And now what we're seeing most commonly in the market is that the seller's total liability for any breaches would be about 20% of the purchase price. Sometimes it's more, if the business is high risk, or if it doesn't keep good records or has had previous compliance problems, it'll be higher. But on average, I would say we're seeing 20% of the purchase price as a cap on the indemnification. Now, of course, there are always exceptions to the indemnification. Fraud, you're not going to get a cap against, lying to people and committing fraud. And then there are some things called fundamental representations. You really own the stuff you're selling, for example. There will always be carve-outs from the caps. But those are the things you shouldn't really have to worry about. You're probably not lying to people, and you probably own the stuff you're selling. It's the things like, mistakes on the financial statements, some employee liability or something like that, or a potential lawsuit that might pop up in the future. Those type of things are where you're going to get your cap around those types of issues. So caps, the first limit. So that puts a cap on the top. Now let's talk about coming from the bottom. So the way to think about this issue here, and your eyes aren't deceiving you, the word deductibles is bigger than the word baskets on this screen on purpose, because as the seller, you want a true deductible. So true deductible, you think about your car insurance, right? So if you have a $500 deductible and you do $600 of damage to your car and you put in a claim, you lose the $500 and the insurance company loses $100 and the $600 is covered. That's the way a deductible works. The way a basket works, it's more buyer favorable. It's a basket would work. Suppose it was a $500 basket, which is insanely low, but just stick with the car example. The basket is, if you have $499 of damage, the buyer just eats it. The buyer just covers that. But if you have $501 of damage, then the seller has to cover all 501. Or to go back to the car example, if there were $600 of damage, the seller has to pay all 600. Whereas with the deductible, the seller would only pay 100. So obviously purchase agreements show up, they have a basket in them, or they don't have anything. And we push for deductibles for the seller. Next issue. So there's two ways to limit it, the top, the bottom. Now let's talk about limiting the duration of that. We're typically seeing the duration, again, not covering fraud or the fundamental reps, being about 2 years. So 24 months from the closing, that's nice. It gives the seller a lot more comfort that, you know, any chance the buyer is going to have to reduce a note or come ask for money back at 2 years largely goes away unless you've done something really, really bad there. So the duration is a key limitation. And again, the fundamental reps and fraud, you're probably not going to get a limit on duration. And if you don't know to ask, you won't get a limit on any duration on them. We do see purchase agreements show up with no end in sight for the indemnification. All right, so I've talked about these fundamental representations. This is another point of negotiation between the buyer and the seller. What's a fundamental rep? What is not a fundamental rep? So there are typically 4 items that are always considered fundamental representations. Ownership of the assets or the shares that are being sold, the brokerage fees, taxes have been paid, and environmental issues. And so environmental issues might seem a little bit odd, but unfortunately the way the environmental laws are written in the US, a lot of them, no matter how you structure your deal, the buyer will be on the hook for some of those issues, no matter what your agreement says. So environmental finds its way in there. So those 4 are kind of the 4 that are always on the environmental reps, the fundamental reps. And then depending on the business or the industry, there might be another 1 or 2 or 3 that get added. We'll occasionally see purchase agreements come in where the buyer's taking a shot at like one that's not really a good fundamental rep, and we'll work with the client's, attorney to say, hey, look, tell them that we don't see this as market. We do a lot of deals, and we don't see people calling that a fundamental rep. That should come out. So those are kind of the 4 biggest areas that you talk about indemnification. Now let's talk a little bit more around the edges here. There's something called anti-sandbagging. So this is really getting into the field of the lawyer. So we might take a look at the purchase agreement and just talk to the lawyer and say, hey, think about anti-sandbagging. But this is something you really need to talk to a lawyer about here. But just let you know what it is so you know to raise the issue. Suppose the buyer comes in and does diligence, and they notice that you have an underground fuel tank behind the factory number 2 in your industrial plant. They write the purchase agreement and say there are no underground storage tanks, and they know about that one back there, and you forget that it's there, or you didn't know it was there, or who knows what, as long as it wasn't fraud, as long as you didn't intentionally deceive them. Yeah. A year later, the government comes and says, oh my goodness, you have an underground storage tank. You got to get this thing out. This is not allowed in our state anymore. Pull that out immediately. And it costs them $100,000 to pull out and dispose of this underground fuel tank. So this is where the anti-sandbagging comes in. If there's no anti-sandbagging provision, the argument is that, hey, we the buyer knew this was here, but you gave us a representation that it wasn't here, so we're going to make an indemnification claim. But if your attorney succeeds in getting the anti-sandbagging provision in, it'll say, hey, I'm making all these reps and warranties, but if you know one of them's not true, at the time of closing, you can't come after me afterwards. You can't sandbag me. So, the purchase agreements never show up with that clause in them, and it's something we like to encourage our clients' lawyers to put in to the end of the reps and warranties. This is additional protection to make sure that clients aren't losing money down the road. Similarly, and I think this is the last thing on indemnification, similarly, you'll have another clause that doesn't come in the purchase agreement, but we discussed with our client's attorneys having this added to the agreement. It's called cross-disclosure. So to stick with the underground fuel tank store analogy or example, there are no underground storage tanks. So the client's attorney, the seller's attorney, will help them write in, except as set forth on the relevant schedule, there are no underground storage tanks. And then they'll attach a schedule to the purchase agreement that says there's a 5,000-gallon underground fuel tank behind factory number 2 in the industrial complex. And they've disclosed it. And so that means that if a year from now the government shows up and says, oh my goodness, there's an underground fuel tank, you got to take it out, it costs you $100,000. The buyer can't make an indemnification claim against the client because the client disclosed it. And so if you don't have a cross-disclosure clause in the agreement, the risk you run is that it might be, section 5.14 that says there are no underground storage tanks except the one on the schedule. There might be a section, that might be section 514, environmental issues. There might be a section 523, real estate issues, and that might say there are no fuel tanks on the property. Fuel has never been stored on the property. And you thought as the seller to disclose it on the environmental rep because it just jumped right out at you. But when you got to that 5.23 real estate rep, you didn't think about it, so you didn't put it there. So if you don't have a cross-disclosure clause in the contract, the buyer can claim, well, yeah, you disclosed it for 514, but not 523, so it wasn't disclosed, so you have to pay me the $100,000 to remove it. Yeah. So, but if you put in a cross-disclosure, it says any item disclosed for one representation is deemed to be disclosed for all applicable representations. Period. You put that in, and you can avoid that type of risk. All right. So moving on to the next topic, and this is it's related. I kind of touched on it in the last one. Your disclosure schedules. So the disclosure schedules, as I explained, you'll be asked to make a representation. You'll sit with your lawyer, and you'll say, well, that's not. It says we've never had a lawsuit by an employee. That's not true. We had an overtime claim 2 years ago, and we had a discrimination claim last year. And what are we going to do? What if those come back to bite the buyer? I don't want to have to pay for those. I'm selling the business because I want out. And the lawyer will say, great, let's put it on the disclosure schedule, because once we disclose it, and then once the deal closes, it's the buyer's problem because we've disclosed it. So your attorney will sit with you and make up the disclosure schedules, and this is something you must do with an attorney because it's a very important part of the contract. You should not rely on anyone else for this. You should do your disclosure schedules with your attorney. Yeah. So these are in essence a form of insurance for the seller. And a lot of times the sellers are in the mode because they've just gone through diligence. They're in the mode of trying to disclose as little as possible and look for reasons not to disclose it. Well, I'm not sure if it's underground because it kind of sticks up a little bit, so let's not put it in there. A good lawyer will say, no, let's put it in there. If it might possibly fall under the disclosure schedule, we probably want to disclose it because it's insurance. Why not get free insurance? Now, obviously, if you disclose something that the buyer didn't know about, they're going to read the schedule before they close the deal, and they may say, ooh, this is catastrophic. We can't buy the company, or we have to change the rep because we don't want responsibility for this. So that putting on a disclosure schedule might lead to further negotiations, but leaving it out means you're keeping that liability. And if you leave it out and you know you left it out, it may be fraud, and you may not get the benefit of the caps, the duration, and maybe not even of the deductible for that. So you need to err on the side of over-inclusion and work with an attorney to prepare your disclosure schedules. A lot of times, unfortunately, clients are burned out by the time they get to this stage. It necessarily has to come at the very end of the process, right? You've done your letter of intent. You've done your whole beauty pageant. You've done your process. You've negotiated your LOI. You've done the diligence. You're negotiated that purchase agreement. You're almost at the end of negotiating 120 pages of employment agreements and leases and purchase agreements. Now you have to do the disclosure schedules, and it takes a lot of time. On some deals, it's the most expensive part of the legal bill is preparation of the disclosure schedules, but it's money well spent because it's a good insurance premium. Yeah. So the clients tend to be a little burnt out and tired by the time they get there, and so they can tend to want to kind of do it quickly or skip things. And you absolutely do not want to do that because anything you leave out can be used against you. All right, speeding up here. I've talked about that. I've talked about that on the disclosure schedules. All right, next issue, reps and warranties insurance. And this is an exciting new thing. This didn't exist about, say, 5 years ago. But this has to come after what we've just talked about on the indemnification, because you sell the business and you think, man, I wanted to sell the business. I don't want to have to worry about something happening in the next 2 years that I have to pay it back, or I gets pulled out of the escrow, or it gets taken off of my seller note. I don't want that. Well, reps and warranties insurance was designed specifically to address that. There are now insurance companies, and there are an increasing number of companies every 3 or 4 months that will insure your reps and warranties. Now, they won't cover fraud, and they typically won't cover the fundamental representations, and they will have a deductible like all insurance. But it's a great new tool that's available for the middle markets and the lower middle markets. And it's so new, in fact, and like everything, it's creeping from the bigger markets down to the smaller markets. And as the insurance companies have been writing these policies for the last 5 years or so, they've gotten comfortable with the payouts they have to make. And so they were obviously conservative with their premiums early on and made them very large. But as they realize the payouts aren't that bad, their premiums are becoming much more reasonable. So they're making sense for smaller and smaller deals. Insurance companies are pretty much, they seem to, we talked to a lot of insurance companies about this, they seem to be wanting a minimum of $200,000 as the premium. It's usually a one-time paid upfront premium. And so that $200,000 becomes a barrier if it's below, maybe $20 million in value. Although recently we've seen some situations where it made sense for some $10 million deals. In a year or two, I bet it'll be $5 million deals that it will make sense for. So if you're not even on the market yet, you're probably looking at anything by the time you get to closing in the range of $5 to $10 million or above. It might make sense, and it's something that you should look at. So the debate here between the buyer and the seller, because both the buyer and the seller, this is one of the cases where they do align, both buyers and sellers like this insurance at present. Amongst the buyer community, there's not a stigma that the insurance companies never pay and they fight you tooth and nail. They tend to prefer to deal with insurance companies to get their payouts than to deal with sellers. And this is particularly true if, as part of your deal, you're going to stay on as the CEO, or you're going to stay on as the regional manager for the Northeast, or if your daughter is going to stay on as the CFO of the business. The insurance company, the buyer would rather have a fight with an insurance company than have a fight with you or the family that's still involved in the business. It may not even be family members. There may just be a lot of employees that are loyal to you even after you leave, because you've been running that business for 20 or 30 years and they've done very well working for you. And the buyer doesn't want to upset those employees as well. So they'd rather go to this third-party insurance company. So everybody likes it, but who's going to pay that $200,000 or more for the insurance premium? So it is technically a policy in favor of the buyer, because the buyer is the one that makes the claim, not the seller. It's not that you have to pay the buyer and then seek repayment from the insurance company. The buyer makes the claim directly. So you would think the buyer should pay the premium, because people who benefit from the insurance typically pay the premiums. Buyers don't agree with that. It's always a negotiation. We've been successful if it's brought up early enough in the transaction that the buyers can kind of still figure it into their purchase price, that we have gotten buyers to pay that sometimes. Most often, we end up with a 50-50 split on who's going to pay the premium. So you take $100,000 off the purchase price for, say, a $200,000 premium, and the buyer buys the policy. So as I said earlier, one of the, some of the things to think about with this is that there's still a deductible, and it's not going to cover fraud, and it's probably not going to cover the fundamental reps. But one of the reasons that sellers like this is because we typically see the escrow shrunk down on these deals, whereas a buyer may ask for 10% of the purchase price in escrow. If the deductible on the policy is only 2%, or for a smaller deal, maybe 5% of the purchase price, then the escrow doesn't need to be bigger than that, because anything bigger than that, unless it's fraud or a fundamental rep, the insurance company is going to cover. So you shrink down the escrow, and you get your money sooner. You have less money at risk. So your actual cash at close, even though my example was going down by $100,000 for the premium, your cash at close might go up by more than that because the escrow is shrinking. Yeah? So one of the reasons that sellers like this quite a bit. So as I said, it looks like it's kind of working down to 10 million in size. Definitely works for 20 million and above. Minimum premium, 200,000. We really haven't seen that come down yet, but hopefully we will as the insurance companies are getting more comfortable. They'll write policies with lower premiums for smaller deals. All right, getting near the end here, we'll move on to the next issue, the non-competes. It is inevitable that as a seller of the business, you will have to sign a non-compete. And there, perhaps if you haven't worked in the business in 10 years, you might get away without signing one, but it just doesn't happen. People do not want to buy a business from you and then turn around and be competing against you the next day. So there will be a non-compete, and we're probably all familiar with this concept. It's different from state to state, but generally a non-compete saying that you can't engage in your profession for more than 6 months, or in some states more than a year, is not valid. And that's true in the employment context, and you've probably been told that as you've tried to sign your employees up to non-competes. But that rule does not apply when you're selling a business. When you're selling a business, the legally acceptable term is much longer. And what we most commonly see is that the owners are tied up for 5 years after the sale of the business. Now, for some of you, you may be thinking about selling, and you think the last thing I want to do after selling is go back into the business. Some of you may be thinking that, but realizing, wow, this is all I've done for the last 30 years, and if things don't go as I plan them to go, I might need to get a job, and this would be the job I'd want. And some of you may want to be doing something that's closely related to what you did that's not necessarily competing, and so you may have put a little more importance on this. This one, on this issue, it may have no value to some of you, it may have tremendous value to some of you. They said for owners, it's much longer than the normal 6 months to a year. So the first thing you're going to want to negotiate with the buyers is the duration. We typically see 5 years. We see them as low as 3 years. Anything beyond 5 years is something that should certainly be attacked. We just don't see those being longer than 5 years from the closing of the transaction. And then the scope also, right? So you want to look at the scope and figure out exactly what they're prohibiting you from. Is it truly direct competition, or is it kind of in the ancillary fields that you might be interested in? You may be interested in consulting for someone else in the future who's in the same industry. Would you be prohibited from taking a consulting arrangement or not? Right? If you also look at the scope, they may say you won't engage in this trade anywhere where we, the buyer, have a business. Well, if you're selling your downtown hardware store to Walmart, you just said you won't work anywhere in the country, basically. So think about how they're defining the geographic scope as well as the type of work that you're doing. And then there's usually a non-solicit that comes along with this. You won't solicit the employees to leave, and you won't solicit the clients or customers to leave as well. Sometimes we see this extend to suppliers in certain industries. So make sure you take a careful look on that and think through what your plans actually are post-closing, to make sure you're not going to trip yourself up. And then the last point on this non-competes is sometimes they double stack, right? So most of the times an owner-operator will stay on after the closing, whether it's for 6 months or 2 years or indefinitely. And there will be a non-compete in that employment agreement also. That employment agreement is typically limited, as you would expect, to 6 months to a year, but it starts not from the closing date, but from the end of your employment with the business. So when you're thinking these things through, don't confuse the two. They'll overlap, but one of them doesn't dominate the other. There are two independent obligations that you're agreeing to. So if this is an issue for you, make sure you understand when they start, when they stop, what they limit you from, okay? So the last point, and I think the most important point of selling a business, aside from the initial valuation, right? So you get your multiple, that's the most important thing. Then there's 11 other things that we talked about. Then there's this one. You might have gotten the greatest multiple from the best buyer in the world as a perfect fit for your business. But if the deal doesn't close, the multiple is worth 0. It's nothing. All these issues that I've talked about, these 11 other issues, are all things that will slow you down. And the number one reason, and we get asked this a lot when we're meeting with new potential sellers, why do deals not close? Number one reason everybody is time. Something will happen. Something will happen to the buyer. Here's a few examples of what's happened that we've seen happen in the last couple of years. Publicly traded buyer, the stock price suddenly falls 25%. They don't have money to do acquisitions anymore. We've had a private equity fund. They find another business that they like more, and they got it at a lower multiple because they weren't represented very well, and they think they're going to be able to walk all over them in the negotiations, so they'd rather buy them. Another case, someone bought another company before our client, and the integration of that company didn't go well, or they had some type of problem with that acquisition, and they said, we have to put all acquisitions on hold till we fix our process. And then the hold comes along. So there can be things that happen to the buyer and the seller, the broker, the lawyer. No one has any insight into what's going on there. Oh, another big one is a private equity fund where the partners had a fight and split, and the champion of the deal within the fund was leaving and had to go out and raise money, and that takes 18 months, so the deal died. So things can happen within the buyer that we have no knowledge or no control of. Things can happen in the market, trade wars, interest rates going up, new regulations. Suddenly Google enters the space and puts $10 billion into your industry, and the buyer says, wow, I'm not sure I no longer have the #1 company in the industry. They're going to be #2 in about 6 months once Google ramps up here. So, and then of course there are things that happen in your own business. You lose a salesperson, you lose a customer, you have a couple bad months, you have a fire in the factory. We have one client that they're great manufacturing business, relied on one big machine, and the machine broke. If they'd gotten the deal closed kind of within the normal timelines, the buyer would have had to deal with the broken machine. But instead, the client had to deal with it, and it ended up derailing the deal. So time. You've got to get through this process as fast as possible. It is a sprint from when you sign the LOI to when you close, more so for the seller than for the buyer. The seller should always be forcing the buyer to move faster at all times. And it gets tough, particularly for owner-operators, because you're already busy, you're already operating the business. You want to keep hitting the numbers throughout the process so that you don't get a purchase price reduction for a dip in profitability or revenue. But you got to be there, and you got to have your team pushing the buyers to move fast, because buyers will move slow. Here are some of the reasons why deals move slowly. So on our typical transaction, our buyers, depending on the deal size, will spend between $250,000 on the very, very low end of the spectrum, and I have seen $2.5 million. I've seen claims for $5 million of fees. I think it was closer to $2.5 million. So they're spending all this money, and ideally they would start the diligence the day after the LOI is signed, and they would have all their different diligence people come. Their lawyers, their accountants, their HR people, their environmental people, their real estate people. They'd all start the same day, and their lawyers would start drafting the documents on the same day. And that's the way, as a sellers, we want the deals to work, because we want to get this thing done. But the buyer doesn't want to incur all those financial commitments. They want to do the diligence first, and they want to start with whatever they're most worried about. If they're worried about your company's bookkeeping, they're going to want to do the financial diligence first. And then when that's done, they're going to want to do the other diligence. And then when that's almost done, then they'll start thinking about drafting the purchase agreement. And they start sequentially laying these things out, and you're looking at 4 months, even if you stay on target. So one of the things we like to do in the letter of intent is get the buyer to put down some expectations for when they're going to start. They can't tell you when they're going to finish these processes, but when they're going to start these processes. And we try to get them to do them as simultaneously as possible. Yeah, so that the seller will incur some costs for closing the deal, but not nearly what the buyer is going to incur. The next reason, and this is something that's becoming a bigger and bigger problem, as the multiples get higher and higher, and particularly if we bring a client and get them a great multiple on their deal, all buyers are using debt. And maybe 10% of buyers right now in the lower middle markets and middle markets are not using debt, but 90% use debt. So the buyer has agreed on the price, and we and the sellers have gotten the prices up as high as possible, very high multiples. The buyer then has to go get the debt financing from their bank or whatever financial institution is going to provide it. And we all know banks are very conservative, and they look at it and they say, whoa, how much are you paying for this business? Well, I need to know this, that, and the other thing. And but the banks can be very picky, and we're seeing a lot of buyers bring the deals back to their banks, and the bank's not supporting them. And the buyer's saying, oh, I couldn't get the debt from my normal provider. I got to go to someone else. Well, they said, no, I got to go to someone else. They said, no, I got to go to someone else. And so this financing, I think as interest rates go up, the multiples will contract a little bit, but this financing issue should go away, because the interest of the buyers and the banks will be a little more aligned when there's some actual interest the banks can make on these loans. But at the moment, And over the last few years, it's been very difficult for the buyers to line up their debt financing, and it has led to, sometimes 6 months of delays. Some deals have had 6 months of delays, and then finally the buyer says, "Yeah, I just can't get the debt," and the deal dies. So financing is something we like to talk about with the buyers early on. We like to know their debt to equity ratio that they're paying. We have good familiarity with what banks will lend, how many, basically look at turns of EBITDA the banks will lend for senior debt, junior debt, mezzanine debt, and we can tell ahead of time if the buyer's expectations for what the banks will fund are unrealistic, right? So we want a high multiple, but we want the highness of the multiple to come out of the equity piece, not the debt piece, because the banks just aren't going to get excited about your business the way a buyer is. So, if you're selling for a low multiple, financing is not an issue. You sell for high multiple, it leads to lots of delays and some broken deals. Another reason, right? Buyers are out there looking for other companies to buy. When you sign a letter of intent, you sign what's called a no-shop clause, and it's binding. And it says for the next however many days, 90, 120 days, we won't talk to any other buyers. But what the buyer doesn't say is, I won't talk to any other sellers. They retain freedom to go out and try to get a better deal. So the longer they can string you along, they basically have an option on your company, a free option on your company, and you have no option on their money. They're going to tie you up for as long as they can, and they're going to go out and shop for a better deal. Now, at some point, they'll have sunk so much cost into your business that they're locked in, but the longer you give them for exclusivity, the longer time they have to shop your deal and try to find someone better. So again, squeeze down that time to increase your certainty of closing that great deal that you were excited enough about to sign the letter of intent. All right, another reason why. Sometimes buyers want you to grow into the multiple. So most businesses are growing, particularly over the last 8 years, and hopefully the next few years at least. And so the buyers come in, they set a price, shortly before the LOI is signed, a price is negotiated, and there's a multiple on historical earnings. And a lot of times the buyers will never tell you this, but a lot of times the buyers will look at your growth rate and they'll say, well, we're not going to close this deal for 6 months. So while this may be a 7 times multiple right now, given the company's growth rate and the amount of backlog we see, the amount of accounts receivable we see, the things we see happening in this industry and the economy, 6 months from now, that 7 times multiple, it might just be like a 6.5 times multiple, and therefore it's affordable. So in 6 months, you might grow to that multiple that they're happy with. In 3 months, you won't be at that multiple that they're happy with. So sometimes they will deliberately set things up to be stretched out just to allow you to grow into the price that they offered. So you're basically then selling the business for a stale price in your eyes, but not in their eyes, of course. Another reason, part of selling the business, when you sit down and meet with the buyers, you're going to tell them how great the future looks and where the business is going to be in 3 months and 6 months and a year. And sometimes the buyers want to sit back and say, all right, let's see if those projections hold up. And so they'll sit back and they'll kind of slowly go through the process for 3 months, and they'll basically wait for you to stumble. And if you wait for an infinite number of businesses to stumble, some percentage of them are going to stumble over any time period. So they're either legitimately hoping you'll accomplish it, or they're hoping you stumble, and therefore they can do a purchase price reduction. So the longer that's stretched out, the more chance there is that your business is going to stumble. And I can guarantee you, if you exceed the expectations, you can't go back to them and say, I know we signed the LOI 4 months ago, but my business has done better than I thought, so I want more money. That never works. So it only works the other way. One last reason. The buyers think that the sellers will fatigue and they'll get desperate. And this happens a lot. And the buyers see it, and it becomes very visible to the buyers, and the sellers might explode at meetings. They might just take irrational positions. And so that's not what the buyers aren't trying to get the sellers to explode. They're trying to get them to be weary and tired and just, look, I don't want to deal with this stuff anymore. Just sign the agreement and let me get out of this business. I'm ready to go. I've been working on this for 6 months or a year. I want out. Just don't. They tell the lawyer, they tell the broker, stop fighting over stuff and just get it signed. I want this closed. That's what the buyer may be hoping for, and that's one reason why they may stall and drag things out and make it a little more cumbersome than it might really truly need to be. That's it. Those are the 6 points that we went through. I think we have a little time for questions. Some I don't have a block here, but do we have some time for questions, Sam?
Yeah, we have a time for a few, and if anybody does have additional questions, please send them over. But we did get a couple as the presentation went along. First one came from Tim, asked, how do I find out more about Reps and Warranties insurance?
Reps and Warranties insurance, we deal with two different brokers that know, they have the latest and greatest information on all of the companies, all the insurance companies that are providing insurance. And it's a growing list. So we actually have good points of contact there. They have specialists at these brokers that deal specifically with Reps and Warranties insurance. So if someone wants to shoot us an email, we can get those contact points. But you definitely want to go through a broker. You can't just call up an insurance company and ask them, because it's not yet a very efficient market for that insurance. You must use an insurance broker, or your chance of getting like a good pricing on that is very slim if you just call up one insurance company.
Very good. Okay. Next one comes from Roger. Yes. You mentioned delays could kill a deal. How long should a deal take?
That's a good question. The key thing for purposes of this discussion is how long should it take between when the letter of intent is signed and the deal closes. And there can be some extraneous things such as third-party consents that might take longer. But a good buyer that has experience should be able to get the deal closed in 3 months. Sign the letter of intent, get started right away on the diligence, get the purchase agreements and the other ancillary agreements started within a month and closed in 3 months. You should be able to certainly sign a purchase agreement in 3 months. And then if there's one or two things that aren't done in time, then you can sign the purchase agreement, make that a condition proceeding to closing, and that may take, however much longer that takes, but at least it's 3 months of hard work to get that done. Now, if the buyer tries to slow things down for one of those reasons, or the seller, we had a seller's attorney that took a vacation to Eastern Europe for 3 weeks, right in the middle of the process. And he was a sole practitioner, and the deal stopped for 3 weeks. So the seller can slow things down at times also, but if the seller's in there pushing, responding to the buyer quickly, and pushing the buyer to move on with the next step, you should be able to wrap this up in 3 months. If it's taking more than 6 months, the probability of close has gone way down. There's probably a problem. That said, we did have one client under letter of intent for 13 months a while back, and we, made the client aware of the risks of being under LOI for that long, and they really liked the buyer. The buyer had made them very confident, but the buyer was having trouble getting financing, and the buyer just kept shopping the financing, and he finally found a debt partner. Deal closed, everybody was happy, but it was 10 months later than it should have been. So there are exceptions to the rule, but kind of 3 to 6 months is the gray area, and 6 months you really need to be kind of reevaluating at that point.
Okay, very good. Got have one more here. This one comes from Dan. What are some of the most common excuses buyers use to delay the process?
So they will. So one thing they'll say, they want the financial diligence done first, which is nowadays the accounting firms have a fancy product they call quality of earnings. It used to be called accounting due diligence or financial due diligence. Same thing, but they charge the buyers more for it because it has a fancy name. So we're seeing a lot now where buyers are saying, I want to do that first, then I'll hire a law firm, then I'll hire my other people to come and look at the operational type of diligence. And so the quality of earnings may take 3 weeks. It may take 2 weeks for the quality of earnings team to have an opening in their schedule and get on site. Then they need 3 weeks to do their work. Then they need a week to prepare their fancy report. Then they need to schedule a meeting with the buyer. And once they have that meeting, then the buyer will decide what to do and whether or not they're going to start the next steps. So they can burn through 2 months just on the quality of earnings. Unfortunately, that is a trend that's happening. I really wish the quality of earnings providers could get a little faster. And I really wish the buyers would stop moving towards, I want Q of E first and then everything else. Because now it used to be kind of, the buyers wanted diligence and then drafting. Now they want Q of E, the rest of diligence and drafting, 3 steps. And that makes it really hard to get done in that 3 months. So that's the first excuse that they're using to not get closed. They don't use the financing as an excuse. It's kind of embarrassing. No one likes to say, I don't have enough money. So the opposite of an excuse, they will find other things to say other than the financing. And so you've got to be in there digging and kind of pressuring them. Hey, how's the financing going? Who's the financing coming from? What are the terms on the financing? Are they supporting your debt to equity ratio? does the financing look good? Because if you're not asking those questions, the buyers just won't talk about the financing, and they'll come up with some other reason. Oh, our guy got sick, or we had a corporate event that we have to go take care of. Something happened in the business, and we've got to take care of this. Sometimes, oddly enough, particularly with the smaller deals, the buyers will just go dark for a week or two, which generally means they're having a problem with the financing and trying to wrap it up. So the biggest excuse for the quality of earnings first, the biggest stage is quality of earnings first, and availability of service providers. We can't get our employment guy down there for another 2 weeks. Well, you can get another employment diligence guy. You don't need to wait 2 weeks. This is a big deal. This is a big process here. This one guy's vacation shouldn't be holding this up. So if they start using excuses about people not being available, that means they're probably covering for something. So those are the only two common excuses that we hear.
Very good, very good. Well, I think that just about does it on time.
Okay.
So thank you, Clinton.
All right, thank you everyone for joining us. We don't have our next webinar planned, but we will send it out, the notification of that through the standard means. Might be next month, perhaps 2 months from now. Thank you all for joining us, and please check out our other webinars that we've posted on the website if you've missed them. Bye.